My name is Daniel Brooksbank with Responsible Investor, and I'm delighted to welcome Manuela Sperandeo, Head of Sustainable Indexing at BlackRock, to ESG Leaders. Manuela, welcome. It's great to see you.
Hi, Daniel.
Just going to dive straight in, really. ESG is such a hot topic at the moment, but what are your expectations for ESG in 2021?
Great to be here, Daniel. Thanks for having me. We're coming out of what has been already a landmark year. In 2020, we have seen sustainability, and in particular, sustainable index adoption really accelerating at a pace that has been a surprise for many of us who have been involved in it for a few years now. So we've really crossed some important landmarks in terms of assets, over 100 billion in index assets just in Europe. But to be honest with you, if I look at 2021, I expect this trend only to pick up. If anything, I think there are some incredible tailwinds that come from regulation, as well as some of the market dynamics that we are witnesses, that I think are really pointing in the direction of these growth and interest by investors to only go up, really.
So there's been some big developments. One that sticks in my mind is the United States re-entering the Paris Climate Agreement. What are the implications of that?
So I would say that, from our perspective, being a global organization, we've had a chance to look at the way sustainable indexing has been regarded by investors across different geographies. And undoubtedly, EMEA, the EMEA region has been leading the charge. I mean, huge development in terms of, as I was saying, regulation, but also I think Nordic asset owner and Dutch asset owner who have been really leading the charge for years now. On the other end, I think what has been interesting to witness has been really the pull coming from the end investor. If you think about the US wealth market, which is really wide. And so what has been interesting for me has been to witness how last year, while in Europe, of course, the adoption was quite widespread across institutional as well as wealth and retail clients, the predominance of the wealth adoption in the US has been really interesting to see, quite unexpected. I think it is something that we were not anticipated to be so prevalent. And one of the key explanations in my mind has been the way some of these products, these building blocks in terms of traditional equity and fixed income exposures, found their place in wealth models. And we know from experience that this is one of the prerequisites for this adoption to really snowball. And so I would say that overall, this is, I think, what the return of the US to the Paris Agreement is going to mean is really actually now an up. In a penetration upwards. If we think about the institutional community, the asset owner community, I think there are going to be interesting development over there in terms of the ability to integrate ESG also in retirement solution, which is something that clearly the previous administration had not looked at very favorably. And so this could be, in my mind, one of the key driver and catalysts for broader adoption also in the institutional space in the US.
We can't avoid talking about the pandemic. What do you think it has it proved the materiality of ESG?
Listen, if I think the number of times I have been asked the question last year, has sustainability passed the COVID test? I mean, I think I would be in the hundreds because, we started 2020 with the big question mark, against this market environment, which was so volatile, so much uncertainty. Of course, the first thing to wonder would have been whether investors would have even had the time to think about sustainability. Well, it turned out that actually the COVID crisis, if anything, has accelerated awareness in investors. And this has been really much proven by the resilience that we have seen in flows. To give you a sense, in Q1 has been one of the most extraordinary in terms of outflows that we've seen in the ETF industry. So we're looking at over 30 billion. At the same time, flows in sustainable ETFs were actually positive. So this was quite remarkable to really see also the shift in preference, the strategic nature of some of these investments. And lastly, clearly there was interest in what was being the differentiated performance. So we estimate that the vast majority of the indices that we monitor actually outperformed during Q1 of 2020. And so clearly, it's quite early because some of these products are also quite recent. They were not launched more than 5-7 years ago. So clearly we have a bit of a limited history. But I think what we have seen, especially last year, was very encouraging. So I think this notion of resilience, both in terms of flows and performance, if anything, has really been proven during COVID.
Another development in the ESG space is the harmony that is threatening to break out in ESG standards. Possibly a long time coming. What is your take on the moves around the convergence of ESG disclosure standards?
This is a big year for us in terms of European regulation. It has been in the making for some time. Clearly, to your point, what we have seen is that there have been regulatory initiatives that, if anything, have front-run what was expected of the European regulation. So clearly, of course, this has meant that in some countries, if we think about France, Belgium, Germany, clearly the previous initiatives around labels had helped investors, given them the clarity about products and clearly encourage adoption, especially by wealth distributors. But clearly, having said that, now there is work that needs to be done to harmonize some of these regional standards to the new regulation. A couple of weeks ago, we clearly all had sight of level 2 guidelines. So clearly more and more clarity is coming. The rush to March 10th clearly is live. Everybody in the industry has really been focusing on that. But I think what is important, my experience in looking at this regulation, speaking to investors, I think it is really achieving what it was meant to do in terms of really encouraging the conversation with the different participants. In our case, has been very close engagement with index providers, what is needed for these indices to really classify as Article 8 as Article 9. And really also work very closely with clients to enable them to report as it's going to be needed to going forward. And lastly, I think really the investment in data. Again, the data that are going to help fulfilling regulatory obligations, the data that are really going to demonstrate and measure the sustainability credentials of these products. So clearly it's a hugely important development for the industry, but clearly long-term is really going to be what it was needed. So I think in a year's time, we're going to be in a very different place from where we are today.
There's another element to all this in my mind, that you're seeing the major asset owners starting to make net zero portfolio commitments. So what are the for asset managers who act as agents for these clients?
Especially, earlier this year, you will have seen that in the letter that our CEO sends out both to the companies we are invested in, but also to our clients. He did make it very clear that one of our key commitments, especially around climate, is really going to be this notion of facilitating this transition toward net zero. And so there are several things that we committed will be doing, starting from this notion of providing choice. So really provide choice for portfolios which are Paris aligned, and so it really can help in the transition to net zero. And from my perspective, being involved in the index solution, this really means working with index providers to launch solutions that align with the EU climate benchmark regulation. So this is a key piece of that. But there are also other parts of this commitment that relate to, again, the data that we make available to our clients on our website and through our portfolio consulting engagement to really give them transparency of the implication that climate has in portfolios with regard to really both risk but also return opportunities. And then, of course, a lot of the educational effort that we do as a firm, and really the thought leadership, because clearly there is awareness that climate risk is investment risk, but there is, of course, a lot that needs to be done in educating the broader investor base on what this actually really means.
Absolutely. And I've just got one final question for you, Manuela, about stewardship. It's a concept that can be somewhat open to interpretation, let's say. What does stewardship mean for BlackRock?
Listen, it's been an incredible journey for us as a firm. We report in a very transparent manner on our voting records, our engagement priorities, and especially there is something very interesting that has been published this year that really in particular relate to climate. And really what this means is really this notion that climate risk is investment risk. So it is something that we're going to hold the companies that we are invested in really and truly accountable for. And we're going to do it taking a few important steps in terms of really measuring management awareness of this issue, managing the progress on this issue, and ultimately, if we're not satisfied, also voting according to our observation of progress in terms of preparedness to transition, and also preparedness to really benefit from the opportunities that transition to a low carbon economy present. So overall, what I would say is that it's a hugely important topic for us. I think being the largest manager in terms of index tracking products is particularly important, because let's not forget, by being invested in an index, it means that we are permanently present in our companies voting. So this is something that we take very seriously. It's a responsibility that we take particularly seriously, and sustainability is at the center of our stewardship efforts.
Manuela, thank you so much for your time today.
Thank you very much. It was great to be with you.